Whether you've been a shareholder for a while or are considering buying Nvidia stock for the first time, you should be aware that this is about more than simply revenues and profit margins. Nvidia recently held their most significant earnings call ever. Since you value your time, let's get going. To say that this was one of the most anticipated earnings calls of all time would be a massive understatement. Nvidia's earnings determine the pace and scope of the entire AI revolution. In this video, I'll break down everything you need to know about the company's most recent earnings call and what it means for the entire stock market. This revolution is just getting started, but it all starts with Nvidia, in my opinion. Given what this represents in terms of attack, it is the most significant earnings of the year, if not the entire decade. Let me explain why there has been so much hype since OpenAI released ChatGPT in November 2022. The Magnificent Seven have been responsible for a large portion of the stock market's returns because companies like Amazon, Tesla, and even Amazon Meta platform firms already have massive data center infrastructures, offer global products and services that are powered by AI, and have a lot of money. The Magnificent Seven outperformed the other 493 companies in the S&P 500 by a significant margin because of this. But even among those seven, Nvidia stands out as the company that everyone should be investing in because it's supplying all the AI chips that everyone else is investing in. This puts them in a perfect position to invest aggressively in AI and outspend the startups and smaller businesses that compete with them, especially at a time when interest rates and inflation are making everything more expensive. If Nvidia's revenue is lower than anticipated, it indicates that businesses are not investing as much in AI infrastructure as previously believed. In a very real way, Nvidia has been driving the returns for the rest of the S&P 500, which is one reason why their earnings are always so important. However, as I mentioned earlier, this particular earnings call was the most important ever, and that's because of Blackwell Nvidia's next-generation AI chip. I believe the Blackwell ecosystem will be the primary picks and shovels in this entire AI gold rush. And the AI gold rush is slowing down for the rest of the market in the event that Nvidia's revenue grows. In this video, I'll guide you through Nvidia's earnings results with a focus on data centers. As a result, its pace and scalability will be primarily decided by how quickly and affordably Nvidia can introduce Blackwells into data centers. I'll describe the current state of affairs with Blackwell's critically crucial next-generation AI chip. Let's dive right into Nvidia's most significant earnings call, where I'll discuss the company's current largest threats, including supply bottlenecks and competition, as well as what's likely to happen to Nvidia stock in the short, medium, and long term. Things get even crazier when we focus on Nvidia's data center revenues, which now account for about 88% of their total revenues. Nvidia posted record revenues of $30 billion for the quarter, which is a 15% quarter-over-quarter and a whopping 122% year-over-year. Nvidia also posted earnings per share of 68, which is 171% higher than a year ago after accounting for their 10-for-1 stock split. I'm not going to cover their other business units today because of this. To be clear, Nvidia's data center revenues increased by 2.5 times in just a single year after becoming a trillion-dollar company and are expected to generate over $100 billion in revenue from AI accelerators. They came in at $26.3 billion, up 16% from the previous quarter and an astounding 154% from the previous year. When compared to Nvidia's two largest competitors, AMD and Intel, in just this year alone, Nvidia's data center sales aren't even close to what Nvidia has in the market. This is why Nvidia has such a strong pricing power, even though it is a hardware company. Its reported gross margins of 75.1% put Nvidia's profit margins on par with most software companies, which is significant given that the global artificial intelligence market is predicted to grow at a compound annual growth rate of 36.8% over the next 8 years. Despite the fact that Nvidia's 75.1% gross margins are actually up 5 points year over year and down 3.3 points from the previous quarter, the company reported record revenues and earnings per share, both of which beat analyst expectations. What's more, Nvidia also issued stronger than expected guidance for the current quarter. This is where things get really interesting. Nvidia's margins dropped because of something in Blackwell's designs that I've actually been calling out for a few quarters now. This is Blackwell, the successor to Nvidia's current generation of GPUs called Hopper. Every business wants these new Blackwell chips because they offer a staggering 4 times better AI training performance than Hopper and an astounding 30 times better AI inference performance. This enormous performance boost allows data centers to extract much more compute power from a Blackwell system of the same cost, size, weight, or other constraints imposed by their current data center footprint. However, Blackwell GPUs are actually 2 separate chips connected by an extremely fast 10 TB per second link. The connection is so fast that it actually fools the 2 chips into believing they are one single device. It's an incredibly ingenious design that circumvents many of the physical constraints of the equipment used to produce these chips. However, not every one of them, as it turns out. The rumored 3-month delay for Blackwell isn't even related to a design flaw. Rather, it's caused by the accuracy limitations of some of the machines at TSMC, the company that manufactures video chips. To achieve those 10 terabyte per second speeds, the placement of these ultra-high-speed chip-to-chip links needs to be incredibly precise. The chip could malfunction as a whole if the link arrangement is even slightly incorrect, since the various metal layers and materials distort and expand when heated up during typical operation. Nvidia's margins dropped to 75.1% for the quarter as a result of TSMC's inability to produce as many working Blackwell chips or a decrease in yield. Less chips produced with the same amount of time and materials means lower profit margins. Regarding the rumored 3-month delay, Nvidia claims to have already made the necessary adjustments to improve yields, and Blackwell production is set to ramp up in the 4th quarter and into the following year. Nvidia anticipates shipping several $billion worth of Blackwell chips in Q4 of this year, and one major reason data centers care about Blackwell in particular is direct-to-chip liquid cooling. Currently, air cooling accounts for over 90% of all servers, which means that many data centers, including hyperscalers like Amazon, a significant shift in the way data centers operate globally is being brought about by Google and Microsoft's massive infrastructure changes to support liquid cooling for their Blackwell systems. Industry estimates indicate that up to 80% of cooling will eventually become direct-to-chip liquid cooling, which is why Blackwell is such an important chip, and this was such an important earnings call. Now that we've covered Nvidia's data center earnings, Blackwell's situation, and the reasons data centers care about it so much, let's talk about the risks. If you think I've earned it, please click the like button and subscribe to the channel. This helps me out and lets me know to create more content like this. Thank you. Now that that's out of the way, let's talk about Nvidia's risks. Beginning with their rivals, there are 2 types of rivalry for Nvidia, and ironically, none of them really compete with Nvidia. Allow me to elaborate. The first type of competition is from chip manufacturers such as AMD and Intel. However, Nvidia makes 5 times as much money from data centers as Intel and AMD combined. In addition, a large portion of Intel and AMD's data center earnings are generated by the sale of CPUs rather than GPUs or other types of accelerators, so they don't really compete with Nvidia as much as they serve the data center market that isn't dependent on Nvidia's ecosystems. Considering Nvidia's greater than 90% market dominance in GPU sales, This is a rather minor portion of the industry, in my opinion. Hyperscalers that produce their own accelerators, primarily Microsoft, represent the second type of competition: Google and Amazon. However, they don't compete with Nvidia for two main reasons. The first, and most obvious, is because they don't sell their processors to other companies. Azure Maya from Microsoft only available within their own clouds, Google's Tensor processing units, and Amazon's Trainium and Inferentia chips assist their own clients with AI workloads unique to their use cases. While over 55% of Nvidia's data center revenues originate from businesses other than these three major cloud providers, and that percentage is only expected to rise over time. The second reason that Microsoft, the reason why Amazon and Google don't actually compete with Nvidia, is because that's not how data centers are designed to function. Allow me to illustrate with an example. Since most individuals only own one phone or vehicle at a time, every sale made by one business means that their rivals lose out on potential customers. Tesla sells one automobile, while GM doesn't sell every phone. The one that Samsung doesn't sell is the one that Google does. But data centers don't operate that way, particularly when it comes to AI. For example, when Google uses its own tensor processing units or purchases a GPU from AMD, it doesn't mean that Nvidia will lose out on sales because data centers handle a wide range of workloads for numerous business types. Data centers are portfolios of various hardware and software solutions. And data center operators will purchase more appropriate hardware to accommodate a certain type of workload when demand for it increases. But their ultimate objective is always to satisfy their clients' shifting needs while cutting expenses. Blackwell would be completely overkill because AI is currently used in very few workloads worldwide. For this reason, data centers use Nvidia GPUs for intensive training and inference. And despite statements from AMD and Intel, they build their own chips for other tasks and purchase chips from AMD or Intel for certain ones. As the industry progresses from predicting words in sentences to creating images and full videos, inference is turning into a powerful AI application. Therefore, even though companies may produce chips that perform well in comparison to Nvidia for large language models, their effectiveness is still unknown for text-to-video models like OpenAI Sora or complex protein structure and interaction models like AlphaFold 3 by Google DeepMind. Ultimately, the complexity of Nvidia's design rather than competition is what poses the biggest risk. Because, although investors may not be aware of it, when Nvidia releases a new chip architecture like Hopper Blackwell or Rubin, they're not creating a single chip, but rather 5 distinct chips that together comprise a whole computing platform. This is because even the world's greatest chip fabrication companies struggled to place their ultra-high-speed chip-to-chip connections. A new GPU, a network interface card, 2 distinct smart switch chips, one for Ethernet and one for InfiniBand, to connect multiple racks together, and an NVLink switch chip in case any of those chips has a problem. There is a problem with Nvidia's whole data center ecosystem. The only other risk worth mentioning is Nvidia's supply constraints, which is why I spend so much time learning about their products rather than just their profits, and why I concentrate on the science behind this stock. Take note of how quickly Nvidia was able to address this issue with Blackwell and how little it affected their overall margins from 78 to 75% for a single quarter. Look, every business on the planet faces 2 types of constraints: supply and demand. As long as Nvidia continues to make enormous strides in processing power, it will face supply constraints. But Jensen made it abundantly evident that Nvidia is increasing supply to keep up with the crazily high demand for Blackwell. The deployment in the real world. What does that look like practically, and is there a delay in the timeline of that deployment, and consequently, revenue from that product? Let's see. It's just that I was so clear, and it wasn't clear enough. Kind of tripped me up there right away. So let's see, we made a mass change to improve the yield functionality of Blackwell, which is wonderful. We're sampling Blackwell all over the world today. We have started volume production and will ship in Q4. As a shareholder, I trust Nvidia's leadership to keep innovating and expand their total addressable market, working closely with TSMC and other partners to meet as much demand as they can. Speaking of which, let's talk about what's in store for Nvidia stock over the short, medium, and long term, because there's plenty for shareholders to look forward to in addition to Blackwell sales ramping up over the next few quarters. Q4 will see billions of dollars in Blackwell revenues, and we will ramp from there. These two processors perform calculations to distribute AI workloads over several GPUs and then combine the final outputs. This previous quarter, networking products accounted for $3.7 billion of Nvidia's revenue, which is actually 30% greater than all of AMD's data center revenues for the same period. Beyond networking sales, Nvidia is significantly increasing its total addressable market by supporting both Ethernet and InfiniBand. This means that in the medium term, more data centers will be able to connect Hopper and Blackwell systems. When it comes to share buybacks, Nvidia is going to be joining the likes of Apple, Google, and Meta platforms. Each outstanding share increases in value when a corporation buys back a portion of its shares because it represents a somewhat larger portion of the business. The board of directors of Nvidia authorized an additional $50 billion in shares. Buybacks in addition to the $7.5 billion in shares that remain available for purchase under the terms of the most recent repurchase approved. I prefer share buybacks over dividends because they demonstrate a company's longer-term confidence and because the former can be sold again at a higher price, while the latter never helps the company's future growth. Buybacks with the release of the new GeForce RTX graphics cards and high-end NIS, Nvidia is preparing for the AI PC market. I believe Nvidia's NIM microservices will be a real revenue multiplier for NVDA in the long run because businesses pay a per GPU subscription for these services, and in the long run Jensen actually announced 3 different GPUs at Computex 2024. For example, Nvidia's Avatar Cloud Engine, or ACE, is built on microservices to do things like translate speech to text and text to speech, match a character's lips and facial expressions to what they're saying, follow a specific set of rules, context, and guardrails, and so on. Because all of these GPUs are architecturally compatible, a data center purchasing Nvidia chips today is investing in the infrastructure that supports Nvidia's future sales, which increases the likelihood that Nvidia will make more money in the future. Additionally, older chips will benefit whenever Nvidia or one of their customers writes a new acceleration library or software application. The Blackwell Ultra chips, which ship in 2025, are the architecture after Blackwell, which is called Rubin, which will ship in 2026, and then Rubin Ultras, which ship in 2027. Thus, as the entire Nvidia hardware ecosystem improves over time, more people adopt it, which in turn attracts more developers, and so on. As we wrap up this analysis on Nvidia, NVDA, it's important to recognize that the company remains a powerhouse in the tech industry, with its leadership in AI, gaming, and data center solutions driving tremendous growth. While some may feel they've missed the boat after the recent earnings report, I believe there's still significant long-term potential here. Nvidia's advancements in AI, particularly in AI-powered software and hardware, are likely to shape the future of numerous industries, offering a compelling reason to invest. Yes, the stock has seen considerable growth already, but long-term investors shouldn't be deterred. The demand for Nvidia's cutting-edge technology continues to rise, and with innovation at its core, this company is poised to keep capitalizing on key market trends. For those with a long-term mindset, buying into Nvidia now could still offer substantial returns, despite its current valuation. However, as always, it's crucial to do your own research and assess your risk tolerance before making any investment decisions. Nvidia is a strong contender, but it's essential to stay informed and adaptable as the market evolves. If you found this video helpful, don't forget to hit that like button, share it with others who might benefit, and of course, subscribe to the channel for more investing insights. Thanks for watching, and I'll see you in the next video.